While everyone was watching the budget, waiting on the RBA, and reading headlines about housing affordability, something actually shifted inside the property market, and most people completely missed it. Most people missed it because it's happening in the data, in the loan approvals, in the lending numbers that the government is required to release, but the media never talks about. And once you understand what the data is showing, the markets start to make a lot more sense. So let's get into it. On the 1st of October 2025, the government expanded the first home buyer deposit scheme. On paper, it looked like a genuine attempt to help people get into the market. They removed the income caps entirely. They lifted the maximum purchase price to up to $1.5 million in certain areas. And they told people that they could buy with just 5% down. Now the intention might have been good, but the outcome? Well, that tells a very different story. And the ABS data tells you exactly what happened next. In the quarter following the scheme expansion, 31,780 new first home buyer loans were written. That's not a small number. That is a surge, and it happened fast. Because when you lower the barrier to entry and tell a generation of people who have been sitting on the sidelines that they can now get in with a 5% deposit, they move, and quickly. The average first home buyer loan size jumped around $600,000 nationally. But here's the part that really matters. With the scheme now covering properties up to $1.5 million in areas like Sydney, you have first home buyers borrowing up to $1.425 million to get into their new first home. That is the new reality for people using this scheme at the top end of the eligibility range. Now think about what that actually means. The scheme was designed to help with affordability, but the loan sizes going up tells you that prices are going up with it. Because more buyers chasing the same limited stock of homes does one thing and one thing only to prices. Here is the thing that most people get wrong about a scheme like this. They assume that because it lowers the deposit required, it lowers the cost of getting in. But that is not how markets work. When you reduce the deposit from 20% to 5%, you're not making homes cheaper. You're increasing the number of people who can now compete for the same homes. And when more people compete for the same supply of homes, sellers get more offers and prices move up. That is just supply and demand playing out in real time. What makes this particularly sharp right now is that the supply side of the equation has not moved at all. The government committed to building 1.2 million new homes by mid-2029. Within 12 months, they are already behind by more than 60,000 houses. And net immigration is running 15% above what the Treasury projected. So you have more people, fewer homes being built, and a government scheme injecting a wave of new demand into the market all at the same time. The people who got in early through the scheme absolutely did well. They accessed the market before the full effect of that demand surge pushed prices higher. But for everyone else that's not moved yet, the goalposts just shifted further away. And it's not just the raw numbers either. There is a behavioural dimension to this that people underestimate. When the government tells a generation they can now enter with a 5% deposit, it does not just bring new buyers in. It creates urgency. It creates fear of missing out. And fear of missing out in property is one of the most powerful forces in the market. ABS data showed that 28% of buyers said the scheme prompted them to buy earlier than they otherwise would have. So you're not just adding new buyers, you're pulling forward demand that would have entered the market anyway over the next few years and compressing it all into a very short window. That is what drives the kind of rapid price movement that catches people off guard. And a mistake people make in this environment is watching from the sidelines, trying to figure out if it's real before they commit. But by the time it feels real, the prices have already moved. Now here is what made this particular moment in the market especially intense. The first home buyer surge did not happen in isolation. At almost exactly the same time, investors came back hard. Investor loans hit $43 billion in a single quarter, and the reason for that is straightforward. Experienced investors could see exactly what was going to happen. You expand a scheme, you widen eligibility, you remove income caps, you allow higher purchase prices. The pool of buyers is about to get significantly bigger. So smart money moved early, before the first home buyers flooded in, before prices reflected the new demand. And what this created was two waves hitting the same part of the market simultaneously. First home buyers and investors are not competing at the top end of the market. They are both concentrated in the entry level, the affordable end, the lower price brackets. That is where first home buyers can actually get in, and that is where investors know the demand pool is the deepest and most resilient. And when both groups are chasing the same properties at the same time, with investors typically carrying equity, higher incomes, and the financial structure to move quickly, you can probably guess who wins most of those battles head to head. Let's put some numbers around what has actually happened to affordability over time, because the shift is more dramatic than most people appreciate. KPMG data shows that a household earning $150K a year could afford to buy around 30% of the market a few years ago. Today, that same household can access roughly 12% of the market. That is not a small erosion. That is a collapse. And it has happened while incomes have grown, which tells you that property prices have moved so much faster than wages that the gap has become structural rather than cyclical. And what makes it worse is that inflation does not just push up property prices, it also pushes up everything. Construction costs, materials, labour. Which is why developers are increasingly gravitating toward premium projects where margins still work, and stepping away from the entry-level housing that first home buyers actually need. So supply at the affordable end is actually shrinking at the same time that demand is surging. That combination is not a short-term problem. It is a long-term structural one. One of the details of the October 2025 scheme expansion that did not get enough attention was the removal of income caps. Previously, the scheme had limits on how much you can earn and still be eligible. They were removed entirely. Think about what that means in practice. You now have higher income households who previously could not access the scheme, entering the market with a 5% deposit and borrowing capacity that lower income first home buyers simply can't match. The scheme was originally targeted at people who genuinely struggled for a deposit. The expanded version opened the door to a much broader, more financially capable cohort of buyers, and they all piled into the same entry-level properties. It's not that the government intended to make things harder, but when you design policy without thinking carefully around the second and third order effects on supply and on competition within the market, you end up helping a smaller group of people and making it harder for everybody else. That is exactly what happened here. Here is something worth being honest about. The government cannot fix this problem. And I'll say that not to be cynical, but because the incentives simply do not point in that direction. The property market is too deeply embedded in the Australian economy for any government to engineer a meaningful price reset. Household wealth is tied to it. Bank lending is tied to it. Consumer confidence is tied to it. If property values collapsed, household wealth would evaporate. Spending would contract, businesses would struggle, and jobs would go. No government wants to be responsible for that chain of events. So what you get instead are demand-side interventions dressed up as affordability measures that can ultimately make the supply problem worse. And if anything, the policy risk ahead could make things more complicated. Potential changes to capital gains tax concessions. Questions around negative gearing. These are the kind of changes that reduce investor appetite to develop and supply rental accommodation, which means the supply problem that is already severe could get worse if the wrong levers are pulled. So sitting and waiting for the government to solve this is not patience, it's surrender. The market will keep moving. The supply problem is not going away, and the gap between people who own property and people who do not is going to keep widening. And this connects directly to the most common mistake I see people make. They treat a structural shift in the market like it is a short-term cycle. They watch the data, they see prices rising, and they think it'll cool off, and they wait. But what we are dealing with here is not a cycle. It is a structural change in demand. Higher loan sizes, a permanently expanded pool of eligible buyers, investor activity at multi-year highs, and a supply pipeline that keeps falling further behind government targets. These are not conditions that resolve themselves in 6 or 12 months. The people who understand that are the ones making decisions based on fundamentals rather than headlines. And the fundamentals are telling you one thing very clearly. Time in the market matters more than timing the market. It's always been true in property, and it's even more true now. Now that you understand what's happening in the market and why the conventional wisdom of waiting for better conditions keeps costing people, the focus shifts to what you can actually do about it. Because understanding the environment is one thing, using it to improve your situation for yourself and your family is what actually matters. If you're going to invest in this market or get into it for the first time, you need to understand where the competition is actually concentrated. And right now, it's at the entry level. The lower price brackets, the properties that first home buyers can access and that investors know sit on the most durable demand. Lower quartile price growth has been consistently outperforming higher price tiers, and that makes sense. The further you go up the price scale, the smaller the pool of buyers. At the entry level, you have first home buyers, investors, downsizers, and rentvestors, all competing for the same stock. That concentration of demand is what drives performance. Now within that, asset selection still matters enormously. A 2-bedroom apartment in the right location has a fundamentally wider appeal than a 1-bedroom. It works for a couple, 2 singles splitting costs, or a small family starting out. The demand pool is broader, and that shows up in both rental yield and in resale. Whereas a very small 1-bedroom in an oversupplied complex can drag, even when the broader market is moving. Getting the asset right, within the right price bracket, is what separates a portfolio that builds momentum from one that stalls. The investors who are doing well in this environment are not the ones with the most sophisticated strategy. They're the ones that understood fundamentals early and moved with conviction. Some of them had pre-approvals ready to go before October 2025 scheme changes took effect. They saw the policy shift coming, understood what it would do to demand in the entry-level market, and positioned themselves ahead of it. By the time the first home buyer wave moved in, they'd already transacted. That is not luck. That is being close enough to the data and having the right people around you to act when the window opens. And here's the thing about leverage specifically. Property has always worked because you are using the bank's money for the majority of the purchase and getting exposure to the full growth of the asset. In a market where the entry-level prices are rising faster than wages and the supply problem keeps getting worse, that leverage compounds in your favour every year you're in, and it works against you every year you're not. So what does all of this mean practically for someone who is trying to figure out their next move? First, stop making decisions based on headlines. The headlines will always find a reason for you to be alarmed. The data is what tells you what is actually happening. And the data right now is showing you surging demand, a shrinking affordability pool, and a lending environment that is still more flexibility in it than most people realise. Second, think carefully about the path you're taking. A lot of people are sitting on savings trying to get a 20% deposit for an owner-occupier in a suburb that they want to live in. And meanwhile, the market keeps moving. Rent vesting is worth genuinely considering. Living where you want to live and investing where the numbers make sense. Letting time and compounding do the work. It is not the conventional path, but for a lot of people, it is the one that actually gets them where they want to be. And third, surround yourself with people who have actually done this, not just the people that talk about it. The difference between getting into the market with a structure that sets you up to scale and getting in with a structure that boxes you in can be years of lost growth. The right broker, the right accountant, the right advice. That team pays for itself many times over. Property is a long-term game. It's driven by inflation and leverage. It rewards the people who get in and stay in. So if you are in a position to invest right now, you've been sitting on the sidelines and you want someone to actually help you look at your options, whether that is your first property or your next one, there is a link below to book a call with myself or my team. In that conversation, we will look at your numbers and get your personal situation together. And you will be speaking with a team who invests themselves and stays at the forefront of what is actually happening in the lending environment today. And with that said, thank you for watching, and I'll see you in the next one.